Advanced Fundamental Analysis. Fama-French Three-Factor Model. The Fama-French three-factor incorporates the fact that stocks with high market-to-book ratio and small capitalization outperform average market returns on a regular basis. Being a version of the CAPM, the Fama-French three-factor represents an econometric regression having the following equation, where RPRF is the expected return of a stock or an index. Alpha is the risk-free rate, which the return of a short-term government bond. RMRF is the return of the market that is on top of the risk-free rate, also called excess return. SMB stands for small minus big, refers to the cap of the companies. And the HML stands for high minus low, refers to the market-to-book ratio. The betas are the sensitive coefficients of RM, RF, SMB, and HML. Market microstructure. Market microstructure theory holds that the specifics of a marketplace significantly affect asset prices. Several factors pertain to the realm of market microstructure. Market exchange type. Depending on the type of exchange between buyers and sellers, markets can be dealer-based, where the bid-ask spread and the behavior of dealers affect prices. Broker-based, where commissions affect prices. Liquidity and order flow. The type and direction of orders, as well as the liquidity on the market, can cause the price to exhibit autocorrelation, meaning that the price now depends explicitly on the price yesterday, which contradicts the theory of efficient markets, which says that prices follow a random walk. Block trades. Block trades is the name for very large single trades. They can disrupt the market price and cause it to overshoot or undershoot. IPOs. Most IPO stocks overshoot and then underperform. There is a tendency of stocks that have recently had their IPO to overshoot or skyrocket at first and then to underperform during the next days or even months. Notable example, Facebook stock. Buyer and seller composition. Institutional traders, such as investment banks and hedge funds, herd on each other and can cause market destabilization. Behavioral finance. Traders on financial markets are, above all, human beings. Every human, hence every trader, suffers from behavioral biases caused by innate human instincts. In order for a trader to be successful, a trader has to be aware of these biases and recognize and combat them before they impede his sober judgment. In fact, behavioral biases can and have disrupted the whole market for short periods of time. Learning about biases will make you prepared for situations when the market behaves irrationally. Hence, you can take advantage of your knowledge and realize profits. The behavioral biases that traders suffer most from are biased self-attribution. Confirmation bias is the tendency to attribute gains to your own predictions, but to attribute losses to external circumstances and luck. Conservatism bias. Conservatism bias is the tendency of some traders to be slow and reluctant to adjust their beliefs in the face of new information about asset prices. Optimism. Optimism bias is closely related to overconfidence. Usually, people and traders accordingly tend to be overly optimistic about their own abilities to predict prices. In a recent survey in the U.S., 70% of high school students claim to have above-average leadership skills. Only 2% say they are below average. Imagine that for an unbiased self-judgment. Extrapolation bias. Extrapolation bias is the tendency of traders to selectively extrapolate the pieces of information they consider relevant. Usually, they take the most publicly discussed information and place too much weight on it. Herding bias. The name of this bias is self-explanatory. People tend to follow the actions of the majority, the crowd. Disposition effect. This is the bias whereby traders tend to be unhappy about losses more than being happy about wins. This bias is the reason why traders keep losing positions too long and do not close them. Reflexivity. Reflexivity is the two-way interaction between an indicator and a variable it is supposed to indicate. Reflexivity seeks to illuminate the relationship between thinking and reality, and is therefore confined to social phenomena. Reflexivity is self-fulfilling prophecy. In a purely financial context, reflexivity asserts that market prices can influence fundamentals. For instance, if a company is in bad shape, if the market thinks it is in good shape, it will cause the stock price to rise. This will allow the company to become better and end up in a good shape indeed, as the market predicted.